we thought it fit. Let us go into the little bit more details. So, why it is not? So basically, just to repeat, trend adjustment clause. This is what consequential loss tariff, gross profit, annual turnover, and standard turnover. These three things we have talked about in previous sessions. So annual turnover is basically when the loss happens, 12 months backward I go. That is called annual turnover. Suppose the indemnity period is for 4 months. So I go back for the last 4 months of the mirror image, 4 months, which has happened. Suppose the loss has happened in July and it has traveled for 4 months. So last year, July, August, September, October, I will take what is my turnover. And so is the gross profit. But as you know, business is a dynamic process. Many ups and downs comes in present and future. Past cannot be a reflection of future. So that's why the right side clause has been inserted very wisely by all the insurers and also product developers. So it says about trend. So this we have discussed, and I'm again repeating it for the benefit of everybody, to which such adjustments shall be made as may be necessary to provide for the trend of business and for variation in or special circumstances affecting the business, either before and after the damage, or which would have affected the business had the damage not occurred, so that figure thus adjusted shall represent as nearly, so it is not a strict indemnity, as nearly, because it is a futuristic trend, as may be reasonably practical. So near word is there, reasonable word is there, practical word is there. The results which, but for the damage. So there can be a very external, various factors, but it should be confined to the damage which has taken place in my MD proviso, would have been obtained during the relative period after the damage. Same thing, IAR policy. IAR policy also rate of gross profit, annual turnover, standard turnover. And the blue marked is nothing but trade adjustment clause, which we have read. So now I'm going for the questions. Coming from the questions only, had the damage not occurred, so that the figures thus adjusted shall represent as nearly as may be reasonably practical the results which, but for the damage, would have been obtained during the relative period after the damage. So Ashok ji, first you help us to understand what do you mean by but for the damage.
Good morning, all the participants, and I'm very happy that one of the fundamental principle of insurance, which is relating to indemnity, that insurers or insurance is supposed to put back the customer to the place where he was before the loss happened. So it happens in all the most of the policies. It happens in material damage section of fire policy. It happens in our car policy. It happens in our normal mediclaim policy, that whatever money we spend at hospital is paid for by the insurance company, not more. So same this trend adjustment clause tries to do is that this but for the damage, it says that suppose damage would not happen in very layman language. There are more complications involved into that, but layman language, if the loss would not have happened, how much money company would have earned in the interruption period. So suppose your interruption period is 3 months, then you say how much it would have done. Now, it sounds a very simple sentence, but as we'll discuss little later, there are many facets of the same thing. So but for damage, this is one of the, this allows you to get the indemnity to the customer as close as possible to the what he would have otherwise achieved.
Perfect, sir. It looks very simple, as you had told, but once you go into a little bit deep on practical examples or real examples, real losses, then it is a complication. Mr. Sashtra, your point of view? if you want to add anything.
Sure, sir. Thanks for having me here today. Good morning to everybody. And coming to your question itself, sir, but for the damage, I believe this is the ideal utopia we're all trying to achieve through the business interruption policy and while adjusting the claim, as to arrive at that number which the insured would have achieved, the gross profit that the insured would have achieved, but for the damage. So essentially, this is the whole crux of the BI policy itself, where we are trying to, like Ashok Jain ji had rightly put it, put him back in the same position that he would have been if not for this damage. So the but for the damage, essentially, according to me, forms the crux of the BI policy. And while the words are very simple and straightforward in terms of how it puts it forth, we are all aware, people who have been involved with loss adjusting of the BI laws, we know that arriving at that number can be quite subjective and is usually subject to very rigorous discussions and negotiations from all stakeholders.
Yeah, so since I'm representing the audience,
Right.
I put one question more here. Suppose there is a scenario like Ashok Jainji was talking about, that 3 months interruption period.
Right.
And I have clients, buyers of mine.
Right.
And one buyer switch away because of interruption. I am not positioned to supply the finished goods or the raw material which he is meant for.
Right.
And he switch over from me to another company.
Right.
And that is a permanent loss of mine.
Right.
So the insurance company will pay for 3 months indemnity period, but my permanent loss is that customer. And that has happened, but for the damage.
Right.
If damage would have not been there, I would have continued supplying him and he would have been my customers.
Right.
So what do you say about that?
Sir, unfortunately, our policy is a consequential loss policy. And as far as consequential loss is concerned, we need to be able to draw the line somewhere. So somewhere along the way, we say that, we are covering consequential loss, but it's also not infinite, because we start going to consequence of consequence, it keeps going on. So the permanent loss of business, I'm afraid, is something that our policies don't cover yet. Because given the fact that we are only taking into account the timeline that it takes for you to physically go back to operation. So while it's a topic that could be discussed at a philosophical level and also at a contractual level, in terms of practical application, we usually stop it where we draw the line when the physical factory is usually back to its feet.
Ashokji, we are talking of reasonably practicable. So this client loss is reasonable and practicable. So are we not being unreasonable in not allowing that customer's loss to me?
So Sashtra, he has explained very clearly and nicely. And I think if you go back and see that, there is a specific exclusion in the policy, which at this moment is not in front of us. But there is a specific exclusion in the policy that loss of market will not be covered by the policy.
Yeah, but here loss of market may be attributed. Again, I'm using
some percentage of your market which is gone permanently. One customer going, big customer going is the one you have lost market. Broadly, it will come under that exclusion.
Perfect. So with this little bit pinch of salt, let us continue with the second question. Train adjustment. Again, as I was talking to all of you, that it is a very critical aspect to decide the quantum of loss. So which are the factors which the trade adjustment is normally required in a BI policy, BI claim, and explain those different type of industries, because there may be hospitality industry, there may be power purchase agreement of thermal power, there may be solar PPA, there may be resorts, there may be trading companies, there may be manufacturing companies, and so on and so forth. So whether it affects the three factors, rate of gross profit, annual turnover, and standard turnover, or how it differs from industry to industry. Ashok Jainji, you can take first. And if you want to elaborate with a particular type of industries, then it will be more clear to us. And then we will go to Mr. Sashtra.
So, Rustagi, this is too broad a question to answer. But anyway, let me attempt whatever I can think of. So now this is like a condition, it's a key condition of the policy, and server is literally duty bound to ask all relevant questions for that particular industry when he's adjusting the claim. Also, when as brokers, we or when the client is putting up his claim, he knows his business very, very well. So what he should be, and now another thing which has changed over years is that now IT systems are pretty good. A lot of data is available with all the insured, or even market data is available in public domain because of the way IT has progressed over years. Information is easily available. So a factor for adjustment is all and any factor, and which would include something internal to the client or external to the client. Example of external to the client can be, suppose you are having a textile industry, example sake, and at this moment as I'm talking to you, textile industry has a bit of difficulty last few months. When some of the markets have crashed by almost 50%. So take an example, in this situation, if a loss arises, server will have to reduce the sales, even if the trend is showing, if you draw a statistical trend line, is showing upward trend, but at this moment, it seems that it is actually downward. So server will have to consider both the factor. In sales example, he'll have to consider both the factor that what growth this company was doing earlier and what industry is doing at this moment in the market. So this is just one example, but then he'll have to consider raw material prices, sales prices, raw material availability, sales availability, power availability. Now power at this moment is not shortage in the country, but that could be power availability. There may be geopolitical situation. So take an example, if your customer was in Middle East right now, very difficult to justify a higher sales in Middle East right away. So on and so forth. There could be hundreds of such factors coming in, and sometime within same client, within same sales, you could have two divergent trends. Example sake, export market has collapsed, but domestic market is doing very well. Or it could be vice versa. So server will have to take impact of both of them independent of each other and come back with one number ultimately. So there can be multiple factors: the timing of loss, how long the loss has been, the effect which is there in the market is for short duration or long duration, a one-off or continuing effect, government policy change, and stuff like that.
And so there are various factors which affect the business, and so the same factors affects the performance of business. The same affect the quantum or the profit or the gross profit which the client, the insured, would have earned during the interruption period. So that is what it is. Shrestha ji, if you want to highlight it more for industry specific, like manufacturing, he has talked about. Other than manufacturing, if you can talk about.
Absolutely, sir. I think just to set the base itself, I think like we had discussed earlier, I believe the trend adjustment is something that is very intrinsic to a BI claim, right? So the trend adjustment effectively is probably the most important thing that all the parties need to be able to agree upon as far as a BI claim is concerned. Because like Ashok Jain ji had put it quite nicely, subjectivity is extremely high because he had mentioned so many factors, geopolitical, internal, external to the company, all of which affect the trend adjustment. And while an adjustment may not necessarily explicitly be made as a trend adjustment as far as the claim itself is concerned, I think all adjustments in terms of how you are arriving at the standard turnover and the standard gross profit has the trend adjustment aspect to it, right? So from that point of view, I believe the trend adjustment is very, very intrinsic and one of the most important components of a BI claim when you're adjusting a BI claim. As far as industries are concerned, sir, I think like you asked, I think this will give better, perhaps a better background if we talk about specific examples. So, for instance, the hospitality industry, which is a high fixed cost industry, so we have tended to handle a lot of business interruption claims there. So, as you're aware, the power industry and hospitality industry, among others, are industries which have a very high fixed cost. So a BA claim, makes sense for them whenever there's a stoppage because your costs continue to be incurred even while you're interrupted. While on the other hand, your revenues have stopped. So they tend to have substantial BA losses. So from the hospitality industry, in my experience, what I have seen is that, hotels tend to project that they are growing at a certain rate over, let us say, a 24-month period. If you take the 12 months prior to the loss, I have seen that insurers are not necessarily completely accepting of simply 12-month or 24-month period. So where there is a upward trend which has been noticed, so they have tended to want to go back little further. It could be an analysis of 2 years, or it could be an analysis of 3 years to see if any incremental trend or decremental trend for that matter is sustainable. For instance, I recall that when I was adjusting losses for a five-star hotel in during the 2018 Kerala floods, the when we were looking at the 12-month period prior to the loss, there had been multiple events, including an outbreak of Nipah virus in Kerala. So this had affected their revenues during a period of 2 to 3 months. So obviously, when you're taking those 3 months as well as a part of your standard period, the insured gets a raw deal because during that time, chances are the revenues and the gross profit has been down.
Yes, obviously.
So this is something that they put forth to us. Again, all of this, when we talk about either an upward trend or a downward trend, uh, and I think the important part is whoever is stating the trend to be the case should be able to bring forth, requisite documentation to be able to substantiate their claim. In this case, the Nipah was fairly, at least in the south, all of us were quite well aware of that the Nipah outbreak had happened in Kerala, but they did also produce literature to that degree with which we were able to convince the insurance company that these 2 or 3 months needed to be taken out of the picture as far as the analysis is concerned. In the other example where I was handling a loss in Maldives, so we had seen that there was an upward trend of about 18 to 20% just during the immediate 12-month period. So the insurer said this seems to be very much on the higher side, and it is usually not in tune with the Maldives market, where it's quite competitive, where so many resorts are there. So where we went back, and we saw that the insured for a 12-month period had not been very active. So they were in the process of rebranding, etc. So from both sides, there was a back and forth in terms of they were saying we have rebranded ourselves, so we are able to charge those higher prices. We are able to bring in the premium clientele. So our market is on the upward trend. On the other hand, the insurers were also saying this is not something that is sustainable in the Maldivian market. So essentially, we had a bit of a negotiation and agreed to something in between. So the trend
Yes.
adjustment I have generally seen is a place where both parties need to come with a little bit of an open mind and a little bit of flexibility, while they should be able to prove whatever that they are claiming with documentation. I believe it's also an area that requires a little bit of flexibility. I'll close out with one more example, sir, from the power industry. So as the definitions, I'm sure that you have wonderfully explained over the past few weeks. So the standard turnover, as far as definition is concerned, asks you to take the turnover during the same period in the previous year and use that as the base for computing your standard turnover and then your standard gross profit. So what we have seen is that in spaces like renewables, especially when we're talking about solar or wind. So the radiation created by the sun or the level of wind that blows, while you can draw a bit of a pattern and take a little bit of this thing from there, trend analysis from there, what we have seen is that this can also vary year to year. I think we live in the age of climate change where we're seeing, places which are drought ridden suddenly are having floods and vice versa. So this is the case with winds as well. Right. So in such cases, what tends to be the case is, let us say that there is a wind park where there are 30 or 40 WEGs, and where only one or two are affected. So we are usually left with two options where we do a bit of a comparison. So we also take into account the generation of the specific WEG which has gotten affected during the same time in the previous year. While at the other hand, we also do a comparison with the other windmills which are unaffected during the same time as the interruption period. So that gives us a trend again as to how the wind pattern has been across years, right? So we tend to go with the wind pattern which is essentially persisted at the same time as the interruption period, because that takes away the whole mystery around has it been the same, has the trend been the same between last year and this being a natural phenomenon. While all of these are not necessarily adjusted under the head trend analysis in our survey report, I believe this all falls into the discussion where we are trying to analyze the trend, and we are actually trying to arrive at what is the right turnover and what is the gross profit that would have been if not for this, the event that has caused the insurable peril which has occurred.
Perfect. So once this recalls me one of the interaction with Milind Bhatwadekar.
Right.
So in one of the discussion, he told me that in BI claims, in trained adjustment, surveyor has to be business plant head plus commercial head. He has to be practically MD of the company to know what type of projections it is likely to achieve in the given scenario, in the futuristic trend. So it has to be 360-degree approach, vision, and understanding of the subjects internally and externally, of the business aspects, like Ashok Jain was talking about, even government policies and all those things. So it is a very interesting and but challenging also, because insured expects that, like you were saying about that hotel industry, some 20% incremental in Maldives or somewhere. Insured will expect that 20 will become 25%, whereas surveyor and insurance company will see whether this 20% or 25% is sustainable for a longer term or not. $1 million questions comes into picture. So also, Jainji, to deliberate with the same subject, can you talk about thermal power plant or any other critical plants, power plants, where there is a purchase agreement, power purchase agreement, which is like, I will give you a scenario to you, power purchase agreement, which is having capacity charges and energy charges by their principal. The technical availability and all those things comes into picture. Plus, the surplus capacity is being sold by short-term agreements or being sold in exchange. So how this type of scenario can be dealt with? Trade adjustment.
Well, power agreement, money value involved are very high. It's also like a hotel industry, which he explained. Thermal power plants at times tend to have very, very high fixed cost because capital investments are very high. So your depreciation and interest usually will be very, very big, a large number actually in power plant. Now, you yourself answered somewhere the question. In the question itself, you have put the answer inside. So first, you have to see the revenue streams which have been agreed under PPA and the exchange, and what kind of you will have what we call equivalent of put and this clauses where who has what rights of demanding the electricity. And then, as you rightly pointed out, the prices on the electricity exchange fluctuates wildly depending on the demand supply situation. And based on that, dynamic decisions are made by the companies to sell at place A or place B. Right. So all these factors have to be considered by, we need to plot them on an Excel sheet, all of these factors. also at that time what everybody else is doing in the market. So if you take in this very same example, suppose your production is 100 units and you are supplying 80 units only to the person with whom you have PPA, and 20 units are being sold on the exchange. Then for a short duration, suppose your claim is only for a month or two, then it's much easier for the surveyor to adjust that this 20, he can take the daily prices of the exchange or hourly prices of the exchange and multiply by the hourly production for that matter to determine the indemnity. But if it is a longer duration, then more complications will arise in that situation.
Yes.
So unless we take one example here, possibly I'll find it difficult to explain to audience that so multiple scenarios will get generated in that situation. So if you were to change, say, the question from thermal to hydro, argument's sake.
Yeah, please go ahead.
So you were to just change the question from thermal to hydro or to maybe even solar actually. So if you have let's say dry months, your production will automatically go down in those months. But while in wet month, your production may be higher. Now, there may be another complication of demand in that situation. Price on the exchange could be higher when the electricity demand is higher, and it could be lower. So there can be a compensating factor. One factor is lifting up the trend clause. Another factor is actually depressing it. Or sometimes it could happen both are depressing together or both are lifting it up together. So trend clause has this very nice thing that it takes care of seasonality also.
Yes. So perfect. So dragging it a little bit more to Mr. Shrestha, a specific question on PPA and BI claim of power plant.
Right.
See, revenue stream, as Ashok Jinji was saying,
Right.
comes from PPA, and PPA, normal PPA is energy charges plus capacity charges.
Right.
But that has a fixed cost. Whereas as a profit and loss account of the company,
Right.
One is this revenue which comes to me as a capacity charges and energy charges,
Right.
plus incentive based on last year performance of plant load factor and whatever it is. That some incentive will also come on annual based performance of my turbines and all that. On one side, it is there. On second side, there is a profit and loss account where my GP is worked out.
Right.
So, and GP normally can be different what you are drawing from the revenue, from the capacity charges, because suppose maintenance you get 2%.
Right.
Hypothetically, but you maintain the plant either by 4% incurring the cost, and whether you incur 1%. If you incur 1%, then you are making some profit out of it because you are ultimately going to get 2%. Whereas if you are incurring 4%, then you are having a dent in your profitability.
Right.
So how this thing has to be adjusted, whether I should take energy charges and capacity charges, and whether I should go for this GP.
Right. Sir, actually, there's a reason why I took the windmill example, because it's a little bit more straightforward. Because
Yes.
I know coming from the 90s and 2000s, my father used to specialize in this whole three-part tariff. So just he could give you a 1 hour lecture on just the three-part tariff, which I'm sure you're also an expert on. So that is very complicated. So let me start with that disclaimer, because I see that the three-part tariff, there's the capacity part of it, there is the production part of it, there's the incentive part of it. So all of which comes into your BI claim makes it quite complicated. Just to demystify and probably simplify that answer a little bit, essentially from my point of view, sir, I will look at the balance sheet and see what is the revenue that I would have generated if not for this event. And I'll assume that the same variable, charges percentage, continues during the interruption period as well. So like you rightly said, it could vary between 2%, 4%, 6%. It is somewhere there for the maintenance cost for most power plants. So that needs to be deducted. So irrespective of how much the person is paying you. So let us say in that example, 100 is supposed to be your revenue, and the person is, as per your PPA, you're supposed to be paid an additional 2 rupees towards, repairs and maintenance. But on the other hand, you're actually expending 4 or 6 rupees. So from that 102 2 rupees, I will be deducting the 4 or 6 rupees. Let's say, let's take for our example 6 rupees. So 96% will be your GP margin. So I have generally seen that in thermal power plant, given that there is actually a coal, which is an input which is involved, the GP margin varies somewhere around 60 to 70% in my limited experience that I've seen. Taking into account just the variable costs usually make up for about 30 to 35% depending on the plant itself. On the other hand, when we look at solar and wind, it is usually accepted to be around somewhere between 90 and 95%. Theoretically, all your costs are fixed because none of it, you don't spend anything on producing the power directly. But having said that, there is always some level of variable cost that we feel is there, depending on how much you're producing, which is the repairs and maintenance cost. So somewhere between 90 and 95% is accepted in the market as far as solar and wind is concerned, as far as the gross profit margin is concerned.
Perfect. So, again, it depends. I'm going to previous questions only. So it depends on the type of industry, nature of industry, what type of factors are there. There are multiple things. And many things comes into picture, external and internal. So let me go to the second question. Otherwise, we can discuss first question throughout the day also. So the wording says before and after the loss. So whether the trade adjustment before the loss has to be considered or trade adjustment after the loss. So there are three stages there. One stage is before the loss, whatever my trade, like you were saying, 20% growth in the guest or revenue is there. That is before the loss. During the loss, suppose something happened, like you were saying, some in Kerala, something has happened, some epidemic and all those things. Suppose it would happen after the loss.
Right.
Third thing is, once the loss has been reinstated and your production or your the resort would have started in its usual way. If something has happened after the affected indemnity period is over. So after is having two sections. One is immediately after the loss till affected period is over. Secondly, in suppose affected period is 3 months and I have taken indemnity period of 12 months.
Right.
So 3 months is affected period where I have reinstated the property and the production has started or the activity has started. Is still 9 months are there. That also comes under after for adjustment. This is the question of mine to Ashok Jainji or sister, whoever wants to take first.
Sashtra, you are taking this?
Yeah, I can take that, sir.
Please.
Sir, essentially, to answer your question holistically, simplistically, would be to say that we will consider everything. Right? We will study before the loss, after the loss. Like you rightly said as the preface, we're trying to become the business head, the CEO here, who is trying to do strategy for this firm, right? For this company, because it is essential that we go beyond just what is there in terms of book profits or what the audited financials essentially tell you. We are trying to understand what the business was, the business is, and what the business would have been is not for, if not for this insured peril acting. So from that point of view, all of these scenarios to me has an effect on the loss adjustment itself. So as far as what has happened prior to the loss, it is obviously something that is affecting the trend or sorry, the standard, turnover and gross profit data that I'm collecting. So it is already affecting, the computation in that sense. So what I need to take into account, for instance, if I go back to the epidemic, example with respect to the Nipah virus. So this was a one-off. So this is essentially an extraordinary item, which needs to be eliminated from this analysis. So my first question will be, or this was just one example. There could be multiple examples where I know I spoke with Mr. Vaibhav yesterday, where he was talking about where there was a fire in a power plant, where there was a substation fire, and for a 3 month period, their export was close to zero. Right. So assuming that the fire or this kind of an epidemic is something that is unlikely to repeat during the interruption period, the effect of this needs to be nullified while taking into account our, for BA purposes, our gross profit and our turnover. So this is as far as before the loss. And after the loss, again, like Ashok Jain ji had mentioned, we need to take into account, so many things, including geopolitical angle. So if there is a war that is started, you could have been exporting to to a country which is now sanctioned, which means you can't export anymore, right? So that needs to be factored in while we are computing the turnover. Whether I think a basic necessity that as an adjuster, I need to be satisfied and I need to satisfy the insurance company with when I'm recommending a loss or a claim for business interruption in a manufacturing scenario, I need to be able to confirm that the raw materials would have been available and that the finished goods would have been sold. We need to be reasonably able to make sure of that, because without that the whole business interruption scenario does not come into question, because it should also not be that an business has essentially gained out of having suffered a loss, and that they may have lost the market in any case, and now that we are paying a business interruption claim to for that, for such a client. It rarely, if ever, happens, is the scenario, but this is something that we always check for, and we need to be satisfied ourselves as loss adjusters, and we also need to be able to satisfy the insurers to that degree.
In after the loss, I mean, there are two bifurcations. That is what I was just giving example. That is during the affected indemnity period and during the balance period.
Right.
So how the balance period of indemnity, like 3 months is the affected indemnity period, 9 months is still there.
Right.
So how do you see that trend, and what is the importance of that trend to the 3 months?
Right, sir. So like you rightly put it, let's take in our example a 12-month indemnity period, of which only 3 months is actually we are considering as the interruption period for the purposes of our business interruption. Essentially, I am not very concerned with the 9 months after that. Only to the extent that I'm concerned is whether the loss in production or the loss in sale, loss in turnover can be made good during this period, right? So if we are talking about a company that is producing at 60% capacity, right? And let us say that of course theoretically there's another 40% left, but practically let's say another 20-30% can be stepped up, right? So this is a scenario that we need to take into account, especially when we are looking at a loss on an output basis, because what has been lost during these 3 months can be either entirely or at least partially made up during the 9 months maximum indemnity period which is left, and to that degree it could alleviate their loss. Having said that, it's not a theoretical discussion whether it can just be made up, because we also need to look into whether it can be made up for in output and also be sold. For instance, I was dealing with a pharma company recently where they had an interruption period roughly for about 3 or 4 months. And we were having this discussion saying, why can't you make up the production in the rest of the 12 months? So what they had told me is that they were selling generic goods. So essentially, when they did not make it available in the market, somebody else has made good,
yes,
right? And that because nobody is waiting for somebody to produce a generic goods just because they're down for 4 months. So that's why I think the platform that you set in terms of what Milinji had said of becoming, a CEO of the company essentially, or at least thinking like one, is very relevant here, because you need to be able to look at the holistic picture from a business point of view.
So, well said. So after the affected indemnity period is over,
Right.
Trade need not to be seen, only capacity utilization or makeup of the loss, if it can be done in residual period, which is unaffected indemnity period.
Right.
Maybe counted depending on lot many factors like you had told about generic, and because production has to be there, it has to be saleability also,
Right.
because merely producing does not make any relevant things. So
Rustagi, if you'll allow me to just
I
add
was
something.
coming to you only. Yes.
No, but on the same subject, what just now you finished, na?
Yes.
Now, I would think that sometime, this future data also helps you sometime to make an agreement with surveyors and insurers. So take an example. How do you agree what price you would have achieved in the indemnity period?
Yes.
Example sake. So if a market is very, very wide market like electricity exchange or a stock exchange, then you have a lot of data points available. But in most commodities, that doesn't happen. Because there are a few producers in the market, and those producers. So how does survey say that? Let's say in the indemnity period, this is the price you would have realized. Okay, and there will be some selected data points which could be brought in by either insured or insurer or the surveyor. So sometime to settle it after the indemnity, after you start the production, after the loss, then next few months, if you look at the sales data, which gives you quantities, which gives you the price both. So those data also could be brought into the calculation and for understanding how market would have behaved in the intervening period of the loss. So you have the prior data, 3 months, 6 months, 12 months, 24 months. You have the future data of 6-8 months available to you. So based on that data, you possibly within those 3-4 months, what would have happened? So Sashtra, which example he gave just now, the example say Maldives hotel. So suppose this hotel is now saying I'm going to charge because of because whatever I had done, I would have say $200 a night I would have charged.
Yes.
The question is he able to realize that $200 after the loss in real life? So if suppose you see 6-8 month data later on, and he's actually realizing it's not 200 but actually 220 at that period, then possibly he'll be within the insured could argue with the surveyor that look, give me 220, but vice versa, if it is realizing only 180 later on, then surveyor possibly will be able to tell him that look, 180 looks more reasonable.
Yeah. So one more clarity I require in this question only. Before and after the affected indemnity period is well taken. During the affected period, which is the most critical, which has to be indemnified to the client. Suppose it is a total loss of the factory, the production and sales has become zero. So will I rely, because business is a dynamic process, for my raw material, like in the first response you were talking about, Ashok Jainji, that raw material pricing, sale pricing, if there is a Middle East situation, if there is a government rules and all those things. Because I do not have any production in sales, so whether I will depend on the industry rates, whatever, suppose raw material prices have gone down or gone up, what is the market, what is the turnover, what is the saleability, what is the pricing of my finished goods, all these factors by other factories in the market. So that would become the yardstick of determination of claim.
So the difficult part there is to get the data. So if you're able to get the data, that is the ideal world. Because it's not very often that you're able to get the prices of your competitors.
Yes.
Right? And especially, I mean, you may be able to say what it was selling at based on, the insured has their ears and eyes.
Document evidence is
Exactly.
difficult.
It's very difficult. So unless there are some published sources that they can get a hold of, which I don't know if it goes to the degree of telling you specific prices of specific products. There is always industry literature depending on whichever the industry is. But we have sometimes also relied on that, sir. I know it's another topic that we're going to be discussing down the line, but where, we were talking about these NatCat scenarios. And, a hotel had been like the 2018 floods that I was talking about. Five-star hotel was affected. So the question was raised as to whether any of the hotels were doing any business. I know that, this specific property has been physically affected. The material damage claim has been admitted. So from that point of view, theoretically, they do have a business interruption loss on paper. the question that was asked, and the same question was asked during COVID as well, is that whether any of the hotels are actually doing any business and whether you would have done any business, if not, even if it were not affected by this loss. So when this question was put forth, the hotels were able to give me some competitor information, some literature that is circulated when they are part of a particular group. So that was something that we were able to rely upon. So this again did not give specifics, but this was able to give occupancy percentages as to what each hotel had achieved in that entire group. So collection of data is as like with everything else, especially claim is, it's quite critical and also quite difficult.
Yes. So taking it along, I'm moving to another question.
Sorry, Rustagi, let me, can I add just something to
Sure,
Sashtra, what he has said?
Sure.
Right. So, let's go back to a step backward before trend analysis. So before trend analysis, what surveyor has done already, he has computed, or the insured has computed already, the standard turnover for the interruption period, previous year numbers, standard turnover, right? So that was the starting point. Now on that coming is the trend adjustment.
Yes.
Right. So question arises, who can invoke the trend adjustment clause? Right. So it can be invoked both either party, that is by the insurer or by the insured. Right. So you have some numbers which is available as a standard turnover. The party which is invoking the trend adjustment clause has to bring the evidence in. So if I as a hotel saying that others did roaring business in that period at 30% higher price, then I need to get the evidence to the surveyor that look, pay me 30% extra. And if surveyor is arguing, suppose on behalf of insurance company, or insurance company is arguing, no, price was 30% lower at that point in time, they need to get the evidence in.
So very, very valid point, sir. Sorry, you were saying something. So very valid point. So basically, on the left-hand side, whatever is being shown on the screen is I go factor historically rate of gross profit, annual turnover, and standard turnover. If the affected insured feels that his business scenario would have been better during the affected indemnity period, whether be it gross profit, rate of gross profit, be it annual turnover, be it standard turnover, or any other features which would have given positive results to that affected insured, then he would like to take shelter of right side column and has to present his case in a most tangible manner to make the claim better from this perspective. On the other side, if surveyor and insurance company feels that the atmosphere, the business atmosphere, the trade, or whatever things are there, which is not affecting favorably the things, then he has to prove that negative trends is there. Whosoever, so it is not that the insured or insurance company or the surveyor has to trigger this trend adjustment clause. Obviously, the insured will trigger if he feels that whatever trade is there, previous trade is there before the loss, will not reflect the true picture. It is much more brighter picture would have been there. On the other side, if surveyor would have felt, like in Marisa's case, they would have felt that 18 to 20% growth may not be sustainable for a longer period, then surveyor has to establish logically or by certain arguments or certain valid tangible factors externally and internally that trade is negative. So I'm coming to this question. How negative events are to be accounted while computing trend adjustment? Any of you can take it.
So your engineer, plus and minus are same actually mathematically.
Yes.
So the way you account positive, you account negative, same way.
See, Ashok ji, you do not give like a slok of Gita or Upanishad because it is very difficult to comprehend whatever is slok is talking about. So explain it.
Sas, you want to go?
Yeah, right, sir. Sir, like Ashok Jain ji had said in a sentence, we need to come like we have been discussing over the last hour. We need to consider both positive and negative events. But what needs to be taken into account as far as negative events are concerned, if it's in the past, is whether it is going to have an effect during the indemnity period as well. Or it could also be a negative event which does not, which has happened or is subsisting only during the interruption period. Uh, s- uh, uh, Rustagi ji, do you want to speak about the wider area, coverage, wider area being affected during this discussion? Or
You can touch upon
right, sir.
that aspect.
So, as far as negative adjustments are concerned, I know we've had this discussion a couple of times over the last couple of days. The example that I tend to go to is the Christchurch earthquake, which happened in 2011, right?
Please.
So essentially, what had happened there, sir, is that Christchurch had in New Zealand had suffered a large earthquake, and New Zealand, especially Christchurch, is known for its tourists thronging to the place. So tourism industry is one of the biggest industries there. So when they had suffered an earthquake during their summer, which is their tourist season, they had a lot of BI claims coming into the questions, some of which ended up going to court. So the court there at least seemed to have taken the view, and also the insurance companies. As a result of the earthquake, the airport itself was shut down for a good period of time. And as you can imagine, where a big earthquake has happened, as we like to say in a lighter vein, the only people who are going there are surveyors and insurers. No tourist wants to go to a place that is just been affected by an earthquake or an atcat. So as a result, no tourists were going there in the first place. So the question that was being asked is that certain hotels had suffered a physical damage because of the earthquakes, certain hotels not so much. So the hotels, as we our traditional BA policies, allow you to prefer a BA claim only if there is a trigger from the material damage proviso, where the material damage proviso has been satisfied, and the material damage trigger is what gives rise to a BA claim. So these were the people who had made the BI claim, stating that I have had a material damage claim. My hotel has been shaken up by the earthquake, so that requires mending. So no doubt about that. That is admissible. So whether the BA claim is also admissible. So the question at this point, which was asked, is that even if you are not physically affected by the earthquake, were you going to have any business? So the answer essentially to that question was no. Reason being that being the earthquake being affected, I mean, even if they were going to have any business, it was going to be minuscule. It was not anywhere close to their peak, numbers that they would usually have in their peak tourist season. So this was the opinion that was, given by the insurance companies, which was eventually taken to court. And I believe in those circumstances, it was accepted. So this question was once again asked during the Kerala, example that I was referring to, where the 2018 Kerala floods had affected the five-star hotel in question. So they were able to provide. That's when I mentioned Rustagi ji, that they were able to provide occupancy numbers during that same period of other five-star hotels which are in the same range to show that they did have occupancy. Because what was interesting in Kerala during that time, sir, is that, of course, again, this happened in August of 2018, which is peak tourist season in Kerala also, because all the Middle Eastern Keralites usually come back because that's when the holiday is in the Middle East. So while that crowd was mostly affected, what we understood is that since water had entered a lot of the homes, at least the ones who could afford it, the local people of Kerala itself had gone to the hotels, which were not affected because their homes did not have electricity. Many of the facilities were affected. So obviously, the ones who could afford it actually thronged to the five-star hotels. So the occupancy was actually quite good, even in the immediate aftermath of the floods. So, I mean, these are just some practical examples, sir. So these are some of the things that we need to take into account, study, analyze, negotiate, and then, based on data that is available to us, come to a conclusion as to what is the net effect that it will have had on the GP during the interruption period, turnover and GP. Ashok Jain ji, anything you would like?
Perfect. Ashok ji, you want to add something?
No, I think we move forward.
Perfect, sir. So this is again very comprehensive questions. I have put certain scenarios for that. What if turnover is increased? I mean, turnover or production, whatever way you take it, is increased due to the following scenarios before or after the loss. So one is turnover is increased or production is increased before and after the loss. First is betterment. Second is expansion. Third is debottlenecking. Fourth is efficiency improvement. Fifth is market improvement. So basically, just to explain to the audience and to both the panelists, like I had done debottlenecking, or I have done the expansion, debottlenecking. Let me explain that question, put up in proper perspective. There had been recently expansion. I have enhanced my capacity, and then after 1 month or so, 2 months, the loss happens. So how the trend adjustment, because my standard turnover will be static, but since I have increased my capacity, that's why my profitability, my turnover and profitability would have been better. Like if I put DTY systems in after POY, then my GP becomes better, because GP of DTY yarn, double twisting yarn, texturizing yarn, is better than a normal POY sale. So that is also, you can say, betterment. Even efficiency level can increase, like I increase my efficiency by doing certain jugaad baji and certain efficiency level. Like in chemical industry, suppose I increase my batch size, so definitely it will affect my costing, it will affect my profitability. And this I had done, suppose 6 months back from the loss date, retrospective, in the past. So how that is going to affect my things? So anybody can take any questions with scenarios, if there is.
Maybe this time let me go first.
Yes, sir.
So one is that you said before or after the loss. On top you have put the question.
Yes.
So as far as first 4 questions are concerned, actually I would think after the loss, very unlikely that it can come back into the loss calculation.
No, one scenario can come, like which has come in one of my clients' case. The project was conceived in the month of February. Purchase order was issued. In April, there was a loss, and the additional capacity has come into picture in August, which was conceived well before the loss. Even purchase order was given and everything was tended.
So to be fair, though I'm broker, I'm supposed to work on client side, but I would think that here I would go for insurer, because insured could have bought possibly a LOP policy in this particular case, assuming it was a physical loss to that new expansion also.
Hey, I'm talking of adjustment, because whatever with this additional capacity, because my project has not been deferred.
Okay, so in general, my answer would be that after event, in almost in all these 5 scenarios, after event is very difficult unless very specific conditions are fulfilled or very specific cases made out. But I don't think I'll be able to bring it forward.
So let us talk about before the loss.
Before. Now, before creates some more, now you already have so many scenarios you have put already. It creates sometime more complication that your new capacity was already in operation. One, let's say, suppose your first case, betterment, expansion, debottlenecking, all 3 are like capacity expansion some way. So let's say, take an example, your loss is in month of April, let's say. and January itself your capacity had gone on stream, and January you had a higher number compared to December, let's say. So December was 80, you have already done in January 100, right? Now, I have seen a case in which February there was no production whatsoever. So if I see the average of the months, then it is even lower than the before you started the capacity. Just before the loss, your capacity utilization even lower than the capacity before capacity expansion, what you had the capacity. Sometimes that can happen, and this was happened purely because of the market situation, and not even that you had a planned unplanned breakdown, etc. So it was because of the market situation. Now, so this is a very, very kindly complex case of facts actually, will depend on particular fact. In this case, we could at least convince the surveyor that please exclude this particular month data. This was the reason, this was the market change which happened in particular month. And that's where future data helped me to establish that I could sell that new output. Because in the future month, I was able to earn. But there also, surveyor came back with an important argument. He says, look, your customer might have been waiting for you. So the moment you started the production, your demand went up. So how do I bring that back into the calculation? But then we found him, fortunately, LOP claim sometimes can take 10, 12 months later than the event. So we had data for a lot of months. So in that case, it supported us. But suppose data was not supporting me, then I'm sure survey will not make that adjustment then. So ultimately, it becomes how you present the data, how you look at the data. And I think you yourself have said a very good thing that sit as if in your budget meeting, quarterly meeting, what you are doing within your own company. So that gives you good light actually. So, but adjustment have to be made for all 5 of this, what you have said in general. For before event something has happened, then adjustment is prima facie has to be made. Unless some contrary evidence comes in, then this adjustment have to be done in the calculations.
Perfect, sir. Mr. Sashtra?
Right, sir. I was going to say that, see, as a surveyor, I tell the insured, I don't want to deny you anything that you're entitled to. So please present all the data that you have in front of me, right? And whatever you have to back up your argument, I'm happy to consider it. And if it, once the data is presented, we are able to ask more intelligent questions on the subject itself. And whether, again, it would have had an impact on the interruption period, GP and turnover, as the case may be. So as long as it can be proven that production would have increased, but for this event happening, we are more than happy to consider it in our loss assessment. So all of these scenarios, I'm sorry.
Any other scenario which you feel other than these 5?
Sure, sir. Sir, actually, a couple of, sorry, I was just going through the questions. I don't mean to skip the gun. One thing I think we should have all mentioned that Reddy sir has pointed out, Ravi Reddy sir, is whether any trend adjustment is required in the GP, right? Absolutely right, because that is something that we need to consider while computing the loss itself, because you need to see if the margins are holding good. And if we are taking benefits of chemicals and a lot of other products where price is quite sensitive to a lot of factors, including geopolitical factors, the GP will vary, right? So, and it may not be the same as what was the case during the the standard period that we are considering. So this is 100% that needs to be considered, whether the GP is holding up. It could go up, it could go down. If it goes down, then we are usually faster to jump on it. If it goes up, we need to look into the whole this thing of whether it was sustainable. But either way, it is something that needs to be considered. So thanks to Ravi Reddy sir for bringing that up. Just one other thing, which since it was relevant to our discussion, I thought I'll address, sir. Mr. Gopal Krishnan had asked if trend adjustment has an implication on the sum insured as well. So I know we are slightly digressing. I'll just very quickly address it. So the answer again is yes. It's funny, I was having this discussion with a broker who had called me a month or so ago. So he was saying that his client is quite worried while taking out a sum insured that he may make profits that may far exceed the gross profit that he's taking out, covering under the BI policy. So I had 2 answers. The first thing is, as a businessman, if he feels his gross profit is going to exceed the BA sum insured, I think he should be very happy. right? So I think he's blessed to be in a business where that, it's a problem of plenty. And second thing is the BI policy gives us, the flexibility of having taking up to a 50% refund. So if he feels that he is going to exceed, it's giving you a pretty open incentive to over-insure. Right. So again, my essential answer is to address the fact that trend adjustment even has an effect on the sum insured, because that is something that the brokers and the insurance team needs to keep into account while taking out even the sum insured itself.
Yeah, so basically, because my sum insured is nothing but my projected gross profit.
Correct.
And as you rightly put up, all these three factors on the left-hand side, if it is affected before and after, whether plus or minus, surveyor or insurance company or the client has to establish, and those all the guys have to be in unison to ensure that proper compensation is given for the trains adjustment. So, and as far as your sum insured is concerned, again, we will have one more session on valuation only. Sir, please.
Just to add a little bit on what Sashtra has already said nicely, that and possibly Mr. Reddy might have that in mind. So now what happens is this trend adjustment clause, particularly when you are getting an upward trend, then if your sum insured is fixed, let's say suppose 100 rupees, and because of upward trend, your claim is going to become 120 at the rate of 120, suppose. Then if sum insured is not adequate, then trend adjustment doesn't help you. Whatever you will get in trend adjustment, you will lose out in under insurance. So like Sashtra already gave the solution to the problem, that you take adequate sum insured and possibly keep an eye on your sum insured even during the year if you are in commodity business.
Basically, yes, as you rightly put up, there are two deductions. One is under insurance, and secondly, this 7, 14 days or 30 days, whatever it happens, of standard turnover. Standard turnover is what train you are with positive trains. So there will be two deductions. One is under insurance, and secondly, because your 7 or 14 days will also increase, because it is not of sum insured, it is of standard turnover. Again, those questions, and definitely we will take that subject, and that is why provision of refund is mentioned, because whatever sum insured you are giving is projected sum insured. So whether it should be next year projection, whether it is next to next year projections, we will discuss that in detail. So since it is already 73 minutes are there, so I'm closing it down and going for the question answers. Because question answers I have not seen, but you have seen it. So I'm coming to my first question. Just hold on. So can we, Abhay Nakum, can we set terms last year GP plus estimated growth rate, for example, 7% plus 10%, etc.? I mean, though it has been answered, but anybody wants to take it.
Sir, my answer to that is, if you set everything in stone like that, there is no need for self-anointed experts like us, sir. So from that point of view, yeah, so jokes aside, I don't think we are able to set something like that, because we're talking about a very dynamic scenario. So I doubt that any insurers in the market are giving that out or will give that out in the future. Ashok ji, anything you wanted to add?
Yeah, so like I said, this clause is for indemnity purposes. The moment you make anything fixed, it becomes like a benefit policy.
Right.
There is no more indemnity policy, so you are turning the basic concept of insurance on its head if you did that. But now it's happening. If you see in some of the insurances, it is happening. Examples like parametric, it's happening that you get just a fixed amount of money, irrespective of loss.
And in UK also, there are some valued policies, valued BI policies for small entities.
Right.
There had been, and now also they may be there. So that is for a small sum insured like MSME or maybe small hotels or restaurant and all those things.
And
Where,
you can
sorry.
also add. You can also add in this. Let's say, sometimes some businesses like you have additional rent clause in fire policy.
Yes.
To some extent, if you that's something which Mr. Nakum is suggesting is something like that. But in all cases, may not be feasible. Yeah.
Yes. So coming to the second question, in fire LOP or MLOP, the basis of sum insured is AGP, annual gross profit, I think so, and fixed standing charges alone cannot be covered. However, under LOP, standing charges alone, such as debt servicing charges, can be covered. In the event of LOP claims, is net loss, if any, to be adjusted or debt servicing charges corresponding to deferred project period is payable. If so, does that mean that LOP provides for modified indemnity? So, number one, you can take this question, but before that, LOP is entirely different than FLOP or MLOP, because in LOP, you have only one single claim out of the many events, insurable event, which has happened during the project period. So the dynamics, the principles are basically different than what is operating LOP policy, whether it is MLOP policy or FLOP policy. But since question has come, anybody of you can take it.
Right, sir. So I think as far as ALOP is concerned, like you had touched upon, my limited experience with it, the computation itself is very simple because usually it's a question of, whatever interruption period has been accepted, multiplied by whatever is the rate that is, again, it could be a PPA rate, if it's a power plant, etc. My limited experience with ALOP, what I've seen is the hardest bit is to arrive at what is the acceptable interruption period, right? Because there's a lot of subjectivity around it because it needs to be A,
Yes.
an insured event, B, it has to be insured and also informed to the insurers. It should also fall in the critical path. So it's more a very, very engineering analysis versus a financial analysis in my experience, Ashok ji.
Yeah, much more complicated.
Yeah. I think he has covered it well.
So let me go to the next question. If there is a integrated industry of multiple production units and all production will be halted due to main CPP plant loss, like which happens in caustic soda, where CPP plant is there. How to calculate LOP? The turnover will be almost rupees 400 crores. I'm extrapolating this question like in glass industry, you have a furnace, and once furnace is damaged, the entire downstream becomes paralyzed. Like in CP, continuous polymerization, if CP is stopped, the spinning mill stops. So there are various things where the backward all industries becomes paralyzed. So answer it, sir. Please, any of you.
Ashok ji?
Okay, I'll take that. Yeah. So, maybe Rustagi, I'll little differentiate because here it seems to be the case that CPP is a combined power plant, possibly captive power plant he's talking, which has gone down. Right? So I think this claim seems to be little straightforward kind of claim that on 400 crore you will have a GP, a different product line. If departmental clause is there, you take, but it will ultimately go to average because the whole plant is gone in this particular case. So suppose your GP is 20%, so on 400 crore annual is 80 crore. Suppose it's down for 3 months, is 20 crore. So I don't think there is any complication sounding in this particular.
So answer is, Arjunji, answer is yes.
Yeah.
Like Ashok Jain was talking about, because if my CPP is down due to admitted perils in the policy, means MD proviso is admitted. When we are talking of quantum only, it will be, since entire plant has come to grinding halt, things like accumulation of a stock clause and all those things can vary little bit. Otherwise, it will be prima facie. Thumb rule will be 400 if it is interruption of 12 months, then 400 crore will be payable. And if it is partially like 3 months and all, it will be 400 divided by 4. That is for 3 months. Will be the claim which should be indemnified if the things is so simple. Or any utility, suppose boiler is there, which is giving process steam to entire multiple plants within the location, then also the same thing happens. If it is ETP also, like ETP get breakdown or fire or anything which is admissible under the policy, material provision is satisfied. Due to non-functioning of ETP, I have to stop plant production, though there is no damage in the plant. Definitely, since MD provision is qualified and there is no other alternative for production and sales, then definitely whatever sum insured I have taken proportionately, it may be given, subject to other things getting qualified. So PK Patnaik ji, how to adjust trade for a newly established company or a new line of products. So both the things, one is new business clause, that is what we know. And second is the plant is existing, but a new product has come into picture.
Yeah, it's a pretty challenging scenario, sir. I think it's down to management being able to provide us the data for the specific product as to what kind of turnover rates, GP margin, etc. that they would have been able to produce. With limited data, it also limits our ability to analyze the data and come to a conclusion, analyze the trends. Yeah, we'll probably in that case have to rely to some degree on whatever projections that were given inside the management before a new product line was introduced. And again, how much an insurance company will be willing to rely upon projections is something that needs to be tested out, in a live scenario. It would be quite challenging without doubt, sir. And the new business clause is something that we can apply, but the new business clause essentially tells you that you take a shorter duration and then you make do with it. It's also not giving you a ready-made solution. So it really is purely dependent upon a lot of negotiations.
And lot of negotiations. आप ऐड करना चाहते हैं कुछ अशोक जी?
There is an extra complication, not only the numbers, there is also complication whether plant could have produced to what capacity. So sometimes there can be serious teething trouble in plants for first few months.
Yeah.
So to prove one way or another is very, very difficult.
Yes, but whether we can take, suppose production is restarted, and for 6 months how it has behaved, it has behaved, the same inferences to that we can extrapolate backward.
Correct. So that's the evidence. That's the documentation evidence of that.
Yes.
So like Sashtra said very rightly that a lot of negotiation will go around this.
So Gopal Krishnan ji case we have taken. Ravi Reddy ji case also we have taken. Mr. Anam, in this case, do we need to wait for 9 months of IP to watch whether the turnover is made good, whatever Mr. Sashtra was referring, during after unaffecting period, whatever balance indemnity, during the period and the trade, and then settle the claim?
Anna, madam, I'll take that question.
Yes,
I think I don't know if it's the right thing to say as an adjuster who's involved with a lot of BA adjustments. Madam, this in any case takes a long time. Usually what I've seen is that where there's a material damage and a BA claim involved, obviously if a BA claim is involved, it's usually an RA-based claim, right? Where reinstatement is involved. So that reinstatement work itself usually takes some time. And by the time the reinstatement work is completed is when your business interruption period also comes to an end. So by the time the RA bills and documentation reinstatement proof is given, and then we go for the verification of the same, and then thereafter all the BA documents are given, usually this entire indemnity period has already run out. I don't know if it's a good advertisement for BI and BA surveyors and the claims management, but usually we have this data by the time we are concluding the claim. So we don't necessarily have to wait. So practically speaking, this 9 months usually runs out by the time the claim is settled.
Yes, I fully agree with you. Practical situation is this. Otherwise, theoretically, yes, claim can be done. Need not to wait for 9 months to complete the entire affected indemnity period. If it is 9 months, if it is 24 months, the things become more complicated even. Because there is an affected indemnity, suppose 3-4 months, and you have 24 months indemnity period in the policy.
Right.
So definitely those rationality and reasonability has to be seen.
Right.
So next question, client has own power plant, solar power plant. Power generated is used for their own engineering unit. In case of loss, they need to buy power from concern. That is what we have discussed, Ashokji, long back. The state government at the rate of 8 rupee per unit, whereas there had been IPP sale power at the rate of 3 rupees per unit. Client problem in case they need to buy power from IPP, they need to get into long-term PPA, which client do not want as they have their own power plant. Will the surveyor settle at 8 rupees per unit, or will the surveyor settle the BI loss at 3 rupees per unit as per the market rate? So unfortunately, this is anonymous attendees. I could have elaborated the questions in much more effective way. But anyway, Shrestha ji or Ashok ji, whoever want to take.
Ashok, do you want to take a stab at that?
All right. So we did discuss this case in one of the earlier sessions.
Yes, earlier sessions also.
So now it depends on, there are many situations now in the market. Number one, it could be your own one particular client's own unit at different location. It could be like lot of airports now have got solar power plant within the airport premises. That could be that kind of case. Then there is now SPVs are being formed. You don't invest into solar power plant, but somebody else invests on your behalf. And then you buy from that party on arm's length basis. Then there will be fourth, which is going on in Maharashtra at this moment, is that you buy in the SPV, you buy 26% equity stake, so that your transmission charges go down actually because of that. So these are multiple cases which happen. So now one simple case, suppose we take that within, say, airport plant, like Kochi airport has a solar power plant inside. Suppose that is lost. Now that will affect total GP of the plant. In practical case, if this is not treated as a separate plant, they are not going to get any claim actually out of it, because your standard 7 days gross profit will be far, far bigger than the increased cost of working which you will have. So this is what, so it will be very difficult within the premises. If you take your own plant is another premises and you are transmitting it to the main plant, but the company is own company. So then you get into interdependence issue. And if deductible, so at the site of generation, you will have a suppose 3 rupees power, and at receiving plant has 3 rupees or 4 rupees gain actually. So the receiving plant again doing the claim is little difficult. I believe some insurance companies have written a policy by which claims is settled at the generation stage. But to my mind, I have had some discussion with some of the insurers, and it seems that this is not part of treaty. So if very small plant, it is okay. Otherwise, they'll find it very difficult to settle this claim. So at this moment, considering everything, looks like the generation company should be able to get 3 rupees, 4 rupees, whatever is the price they have agreed to sell it to the consumption unit. For the moment, consumption unit will not be able to make any claim. They'll be able to make the claim will be approved, but it will fall under deductible, generally speaking.
Yeah, so there are different aspects, even whether that solar plant has got separate policy with BI, whether it is wheeling, whether it is a PPA like with SPB and all those things. So many things are there, but these claims are also complicated claims. Whether it will be 3 rupees or 8 rupees, what will be the deductible, whether of solar plant, IAR policy, whether it will be IAR policy of the manufacturing plant. So many things comes into picture. So it is if you want effective things, we have to think scenarios, and accordingly we have to incorporate in our RFQ, and has to ensure that underwriter also understand those situations, and accordingly reword the policy contract to take care of this type of vigility, so that you also know as a intermediary, you also know as an insurance company, you also know as a surveyor when it comes into picture, you also know as an insured, whether I'm going to get 3 rupees or 8 rupees, and what will be effect of my deductible, whether it will be of the factory, which will be much more, whether it will be solar plant per se, which may be division, which may be SPVs, which may be independent to even SPVs. So visualize all these scenario and accordingly take prudence at the time of underwriting. It is very difficult at times to convince insurance company, but that should be endeavor of if we want to keep the insured interest in intact position at the time of claim. So going to the next question. Next question is repeat question, which we have already talked about. So as per GI Council deductible adopted by insurers, I'm not very sure whether the statement of fact is there. Time access, number one is time, again question mark to time. Under SFSP policy, 7 days of gross profit, where time access under IAR policy, 7 days of standard word has been inserted for not for SFSP policy, but for IAR. So two things. One is time. What do you mean by time, and whether this is the statement is correct? And secondly, whether a standard word is missing in SFSP policy, LOP policy, FLOP policy.
Right. Sir, so first
Please, next question to it. There is a
Sorry?
question continues actually.
The next question.
I could not get you, Ashok Jain.
Question continues in the next para also.
Achha, my question is, what is the difference? Achha, sorry. No, that is a different question. Oh.
No, same person.
Maybe same person, but question is different. What is the difference
My
between
question is,
gross
what is the
profit and
difference
standard
between gross profit and standard gross profit? That's the question.
But first question is deductible. So my question to you is, what do you mean by time access, and whether the standard word is missing in LOP policy, FLOP policy?
Right. Sir, we had always been applying standard gross profit regardless of
Exactly
what the policy exactly said. So
Yes.
essentially, in the adjusting world, the loss assessor world, we have not made a distinction between the two. I think the distinction that Rustagi was touching upon is that what is provided in the Indian scenario and part of the whole British setup is not essentially a time excess, because it is talking about a 7 days of standard gross profit. Versus, I believe in the American market, and I've seen only policies in India where it is actually offering you a time excess. So I refer to in the American parlance as a time average daily value. I'll explain what that is. Let us say that you have had 50 days of interruption, right? So, and then your policy talks about a 7 days of excess. So what essentially we are doing is whatever gross profit, loss of gross profit you have arrived at for 50 days, you simply deduct 7 by 50, a proportion of it, and you pay whatever is attributable to the rest of the 43 days. This is not the scenario with an Indian policy, or basically the British written policy as I understand it, where they talk about 7 days of standard gross profit of the company as a whole or the department as a whole, which wherever you're narrowing it down to. So the difference between the two is that where we spoke about the 7 days of loss, the moment your interruption exceeds 7 days, you are basically guaranteed a business interruption payout. However, on the other hand, in the regular Indian policy, which is available in our market, unless your policy in your loss in quantum exceeds 7 days worth of standard gross profit, you are not going to see any ultimate payout from the insurers.
Perfect. So these questions we will take in detail once we talk about deductibles and all. like to supplement whatever Mr. Sashtra is saying, there may be ICW claim, increased cost of working claim for 1 month. Still, it may be less than deductible of 7 days of a standard gross profit. So it does not mean it is not a time axis, the first 7 days. It is quantum oriented in India and UK.
Correct.
So coming to next question. Just hold on.
Is there any guidance that can be given for arriving at BI sum insured for ITS company? And then question continues. Can you help with the BI loss, especially from variable cost perspective? Is there any impact of the trend adjustment for this industry, IT?
Good question. For IT or any other service industry, even for broker or any other consultant, maybe architect, maybe doctor, or maybe any others. So IT companies.
In general, I would think that ITS in general won't possibly need a full-blown BI cover. Their maximum need can be maybe additional rent clause in general, unless there is a specific condition for that particular company that they can operate only out of that premises. Example sake, it can happen that you have an agreement with a US company where your premises is approved premises, that you have to work only from that premises and you cannot work even from home for that particular company. Example sake, then they'll be better off buying a BI policy. Otherwise, when there is a work from home going on now, for most of the service companies now, possibly BI policy will not be of great help actually to them.
Yes, study.
Sir, 100% agreed. I've barely handled 1 or 2 of the ITES. It's not a hotbed for us for claims, because clearly for reasons explained by Ashok Jain ji, because they just take a system, go home and work. Their productivity is hardly affected. So from that point of view, I think it's not a very hot industry. Having said that, I think the BA loss can be arrived at typically from a fairly, balance sheet analysis, financial statement analysis of the same, where you're arriving at the GP margin. And also you can take into account the trend adjustment that, the person is asked for, depending on how they're seeing their business grow.
Yes, so normally, typically, because there is very less variable cost perspective,
Right.
that's why the scenario is different. But I'm posing a question to both of you. Suppose I'm not talking of cyber interruption, but I'm talking of suppose there are servers, and all those servers there is a fire.
Right.
And because in servers even smoke spread over, and due to AC conduit and all those things, and very sensitive for heat and smoke. So entire server room, entire whatever we say that hardware things get damaged. So definitely it will affect the business. So whether that type of things in IT company, because IT company I'm talking of, not only software company, it may be hardware company also.
Sir, if I'm not mistaken, I think Ashok Jain ji probably may be able to give you better background. If I'm not mistaken, most of these things are double backed up. So even where you're talking about servers, I think if one physical server being affected, as I understand it, at least in theory, that's the security with which all of us maintain our Microsoft, Gmail, and all these accounts. I don't think it's dependent on one scenario, but I'm sure Ashok Jain ji can illustrate further.
Yes, Ashok Jain ji, even there is a component called switches and all. Yeah. If those switches, I do not know whether that is also contingency is there.
So, it can always be there, but first thing first, let's say suppose if it's a hardware business, then it's nothing but a manufacturing business segregated from ITES, that business. Hardware business is a different business than ITES. Now you come back to ITES. Now what has happened in last 4, 5 years, 6 years, that a general trend, in general, particular company could be a little different. So you need to ask your client basically. But in general, everybody has shifted to cloud now. And cloud, you have got multiple backups at multiple places, and it's available all the time actually. So I can't see a scenario now when you will lose your server. Very, very difficult for me to see. It can happen for cyber, and you will never not even come to know where your server is actually. I can give my own company example. When suddenly we had to close down in COVID, I don't think we suffered at all because we were on VPN and everything. Business continued as it is. And after that, because we used to have servers in those days in our office, but after that we realized this still is a little bit of risk. So we shifted to one of the cloud-based platforms. And I don't think we see any interruption whatsoever, and we don't even know where our servers are now.
Perfect. So,
that's not my premises anymore, right?
yes,
And I don't even know which premises they are actually.
yes, they are purely virtual for me.
Virtual,
So,
yeah.
it is already 10 minutes beyond, but there are only two questions. So, this question from Madam Priya is, suppose there is a BI loss in machinery breakdown under IAR policy. Machine got repaired under indemnity period. Post that is also initiating the business. So that is paid under MLOP policy, subject to terms and condition. While the machine was running, after 3 months, same machine got breakdown due to same part damage, which has happened. So what she's saying, if I understand correctly, linking to the earlier repair or earlier damage, it is there. Suppose link is established that either machine was not repaired properly or whatever it is linked to the old damage only. So the two questions. First question is significant. Second is more of a hypothetical. Will this be a part of single claim of MLOP policy, which are under process? So 3 months claim you have paid. Then again, after 3 months, again, the machine got damaged and interruption of production is there. And it is established that it is the same loss which has happened. Again, linked with the previous loss. So whether deductible and all those things will be same or what? Shrestha, if you want to take it.
Sir, first thing I want to say is same part failing one more time. I would say good luck getting your material damage claim proviso satisfied, accepted. Assuming that it is, it will 100% be treated as two MLOP claims because these two being two different material damage claims, there will be two different MLOP claims, two different excesses being applied.
Perfect. To answer the second question, how can this risk be covered when the policy is expired? I think your question answers that. Your answer gives the first answer, gives the second question answer. Since they are two separate claims, insurance has to be continued at that time of second claim also. Is it correct?
Correct. Absolutely.
No, but possibly the question might be that will insurer insure it next policy period?
With loading, he may.
With loading, he may, yeah. No, but premium still may not be adequate.
Yes. So, Mr. Bharat, Mr. Bharatri Erode, sir, how the ROGP will be arrived at for new company which is not having any previous experience. So how the sum insured will be determined for a new company?
Sir, I think he's referring to ROGP. I think we'll again have to go back to the new business clause.
Yes.
It basically says that you take that whatever data is available in front of you, which may be less than a year, and basically use that for the purposes of any computations. So if it's 3 months or 6 months, as the case may be, so that's basically what you start with.
So again, Abhayji is asking from the first question. So whether agreed policy or benefit policy can be taken on valued policy, basically.
He's very determined to get that policy.
You are broker.
Sir, if you do get it in the market, do let us know. I'm sure a lot of people will be interested.
Yeah, because I had done one exercise and where I had involved your father as well, Mr. Srivatsan, because that was a multiple product agrochemical company, big company. And they were apprehending and the contribution was varying from -2% to 40%. Okay. And that plant was making multiple type of product. Facility was there, which you can switch over from one product to another product. So what they are saying that I want valued policy because at the time of claim, I will be at the mercy of surveyor because he will say you make 40% wala profit wala plant and wipe out the entire loss. And whereas I will say I have to make as per my production planning and deviation and variance and all those things. So these things do happen. I mean, valued policies are not prevalent in the market. And logic may be because business is a dynamic process.
Right.
If tomorrow Middle East something happens or tomorrow recession happens in Europe or after Mr. Donald Trump some anti-dumping duties comes to China or one China policies and lot many things happens which affects the business scenario.
Right.
So it is not prudent on the part of intermediary, on the part of insurance company also, on the part of insured also, to have a valued policy for simplicity. Everywhere, simplicity is not the perfect solution. May not be a perfect solution. That is my take on that.
Plus, TT will not cover for insurers.
TT is something different.
No, but they can't keep it on their net, right?
Yes.
So you should not do something which they don't have actually. They can't sell what they don't have.
That insurance company itself will not give.
Correct.
So we have exceeded some 17 minutes as usual. So thank you very much.
There is one last question, but you can answer is no to that.
Some last question has also come.
Answer is no to that. A client is profit you can't insure. In very limited circumstances, some profit may be involved. Client should buy his own cover. Answer is this.
I think to the extent that it affects your business, you can get a customer premises extension. But yeah, if you like Ashok Jain,
customer extension will give you loss at his plant, leading you to loss will pay, not customer's loss.
Right, correct.
Right. So customer's loss generally will not be available to you to buy insurance.
So thank you very much, entire audience, and it is your motivation which keeps us going. Basically, we are going slow, and the objective is that we understand the concept, and we should be in a position to apply those concepts in real situations whenever unfortunate things comes into. And the basic objective of entire thing is that my client get proper indemnity at the time of claim, speedily, quantum-wise, quality-wise, everything becomes together. I mean, that is the basic endeavor of IBI and entire insurance industry also as at large. So that's why we are going slow. And there are various aspects of BI, which we will take one by one in another subsequent webinars. Webinars we do, as you know, on second and fourth Saturday at 10 a.m. to 11:30 a.m., which goes up to quarter to 12 a.m. normally. And recordings are available on IBI website. This time, these recordings are live on YouTube and LinkedIn also. And recording will be available on YouTube also. All the previous recording is also, we will ensure that that is also placed, recorded in YouTube also. You can take cue or benefit. I also request you on behalf of IBI, as Mr. General Secretary Mr. Narendra was talking about, that you give us feedback so that we can improve upon with the effective communication, so that our objective of spreading the insurance knowledge is fulfilled partially or whatever it is. So thanks for your endeavor, and it will not be complete until I thanks both the panelists who have taken a lot of troubles to answer these questions based on their theoretical and practical knowledge in this vast field of insurance. And I also thank this tech support, which has made us uninterrupted communication with all of you. If you want to say something, Ashok Jain ji and Sashtra ji.
No. Just want to thank Rustagi ji and his colleague Vaibhav, who help us a lot on this.
Yes, that I have forgotten. Always you remember. So thanks, Vaibhav, and other team members, Vaibhav being main. He is helping me for not only for drafting the questions, for entire things in the process of understanding the entire concept and which concept we should take next. So we will come back to you with the next topic related to BI only, because BI is not far complete. Like deductible, sum insured, lot departmental clause, lot many things are there. Then add-on covers. We will come in slow pace. Sashtra, if you want to say something.
Thank you for having me, sir. Always a lovely experience speaking with you and Ashok Jain ji, and also answering the questions of the audience.
Thank you.
All
Namaskar.
right, thanks. Have a good day.
Same to you, sir.